Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, I'm going to be talking about home building stocks. Recently, Lennar, ticker LEN, has been hit pretty hard. I think it was down even more today after more than what's shown here. And it's already down quite a bit off its highs. And I wanted to just talk a little bit about home building stocks in general. And then I would also expand that to stocks that or businesses that just support building things in general. They kind of go into that. So like if you're building homes, you're probably building other buildings too. And so you think of, drywall company, lumber, building materials, like bricks and concrete. And, there's a lot of different things that kind of go into making new buildings, right? So they're not going to match up precisely with home builders because there's different dynamics between them. But what I'm going to try to do is simplify things, and which is, even though my videos can be kind of long sometimes, I do think I try to boil things down to like what actually matters. So I'd only spend time on things that I think are important. I almost think that that's my job. Like, really, there's a lot of information, and it doesn't mean that it can't be valuable depending on what your goals are, what you're trying to do, what you want to know. But as a stock investor, I try to boil things down to the most important point, 2 points, 3 points to consider. And then if you can get those kind of right, then usually, at the very least, you'll avoid making some of the worst mistakes, I would say, which is very important. But it can also, find you some good deals at better prices and things like that. So as always, just not individual investing advice, just how I analyze stocks. So the main chart, so this is Lennar, home building, right? $32 billion company in the US. You can see that during the Great Recession, which was a housing focused recession, their earnings fell off a cliff. They were losing money. But since then, I'm not going to pick the exact bottom here or the exact top, but since then they're up like 2,000% or something. So if you can buy one of these near the bottom of a big cycle, you can do really well with it. But the problem is if you own one going into a big downturn, this is going to be over an 80% drawdown, 95% drawdown. People just can't handle that kind of pain, and usually that's why the stock keeps going down and down. But the thing here is, this is not unique to Lennar. So this is a drawdown chart of Lennar, KB Home, Pulte, DR Horton, NVR I didn't put in here. I think I have a video on it either here or Patreon. I have a free tier over on Patreon, along with weekly picks for $25 a month. So check those links out down in the description. But there is a free tier there. I don't remember where I posted that NVR video out a while back, but it did a little bit better than these in the graph. So it didn't do that much better. The pattern was still the same, but it wasn't quite as clear, and it kind of muddied things up a little bit when I had it in here. But what I want to show is that these all are following the same basic pattern, and the drawdowns are pretty similar, although the recovery times were different for some of them. KB Home kind of more slowly recovered. So it's not that there's not individual differences between the companies, but the macro is going to affect these like 90%, right? That's 80 to 90% is going to be, that's what it's going to be, not the individual businesses. So once you realize that, and you have one of these home builders that's been around for like 30 plus years or more, then what I mean by that is it's not like a new one that could be much scarier, actually, and much more vulnerable potentially. Then you don't have to do a bunch of extra research on each individual company unless something pops out as not being good, and then you can exclude them and just focus on the ones that you don't see that with, because they're all going to trade pretty closely to the same. Okay. And history is a good guide for the future, which a lot of people don't want to recognize or don't fully appreciate. So here's the deal. If I can take some of these stocks back all the way to the 70s on their on some charts that they're not here. They go back to like 1990. And you'll see two patterns, drawdown patterns emerge. One is what I just roughly call the 50% drawdown, and that's the one in 2000. Actually, it was started in 97 or 98, right? This is actually moving in the opposite direction. It fell before the tech bubble burst, which may be kind of interesting seeing what happening is now, but I'm not going to draw too many parallels to 2000 because that's a little bit off topic. But this is like a 50% drawdown for these stocks. Okay, if we go back to the 91-ish, there was a real estate bust at that time. And they also fell, give or take, about 50%. And there was a brief recession during that time as well. These 50% drawdowns are pretty normal. So that's one set of drawdown. And then the other type of drawdown is the disaster that we saw in 2008 and 9, which shouldn't be a surprise. Generally, in my mind, I think this big type of drawdown is investable when it gets to like 80% off its high. Now, we saw it went down, and this one went to 95%. But here's the 80% line I probably picked about when I was measuring the 80%. So you can buy way down here, and you're going to do good if they don't go bankrupt and the economy recovers someday. But what's important here is, sure, you can invest in these companies when they're not in drawdowns, but you're basically always going to be at risk of one of these drawdowns like coming along. So this green part is the earnings. I want to get rid of that for a second here so we can actually kind of see. If you own it during one of these peaks, right, it could take you, well, I'll go all the way up. Let's go all the way up here. So from 2005 to 15 years, inflation adjusted, you would have earned no money, right? If you would have bought it during the peak and held it through that downturn. Now, we never know when these peaks are going to come, right? Plenty of people were buying up here, right? And now they're underwater. They might be the same situation that the people that were buying back here during the peak. Because these drawdowns can be so deep sometimes and take a long time to recover, or both, I don't like to buy them when they're making new highs and when they're in an upcycle, because you really never know when the down cycles are going to come, right? We had some false ones here, right? This one. So, which you can get shaken if you're like, oh, I'll just put a trailing stop on or something like that, which isn't a horrible strategy. Well, what if you got stopped out at 30% or something, and then the stock price comes back and now you're up here? So there's not an easy way, I don't think, to do it, unless you're really, if you're working in this industry maybe and you have some insight into what's happening and some foresight about the odds of things getting better or not, then that's a little bit different. And that goes for kind of any industry. But since I cover most industries, or at least consider buying their stocks, now there are some that I exclude just because they don't fit what I do. But generally speaking, I'm not an expert on the home building industry, right? So I know I don't have any special kind of insight that's going to let me know when the next downturn is going to come and then how bad it's going to be. But what I can do is look at history and see what the downturns look like in the past, okay, which is what I just showed everybody. So for me, when I look at all of these in this situation, if it feels more late cycle to me. I mean, if you look at, and I mean like business cycle, like recessions and things like that, right? Which we haven't had a real recession since 2009. It's been like over 15 years, which is a very long time to go without it. Technically, this pandemic was a recession, but we know that it lasted like 3 seconds, basically, and we had an immediate recovery and boom afterwards because of all the money that was put into the economy. So it wasn't like a real business cycle, right? It was just a crash, basically. It was like an 87 style crash, more so. Now, I'm not a technician, but when I look at this looks like a pretty good looking head and shoulders forming here, right? Which usually when that happens and stocks crash afterwards. somebody who's a better technician than me can come along and tell me that I'm wrong, and I will take their word for it because I'm not basing anything on that. But what I will say is we know we've had a gigantic upcycle in home building. You can just look at the stock returns and the earnings and everything and tell. So the question is, I would not buy any of these stocks unless they were at least 50% off their highs. I wouldn't even consider it. And then and then it gets to how much risk do you think there is to the downside versus the upside? It's possible inflation could play a big role in this too. So I think you can make a case that because of inflation, which we've had in the distance of this chart, we've had like 30% inflation, right? That could raise, because deflation is what we had in 2008-9, right? Well, we had inflation before Goldman Sachs told us oil was going to $200 right before it crashed. So these guys, which was causing the inflation that we had back before this. So you have inflation, and then when things crash, you have deflation. But if you avoid it, right, if you avoid the super crash or whatever, maybe by using inflation as a tool against it, which is what we did afterwards last time, the Fed's already cutting now. So they're trying to kind of perhaps get ahead of a recession and things like that. I don't know how that's all going to turn out. But so what I'm trying to do is make the opposite case for what I actually am leaning toward, right? The opposite case would be, well, we have a housing downturn, interest rates get lower, more people, they build more houses, more people can afford more better houses, and the homemakers make more money, and the people with the building products also get out of this down cycle. And then it's just like a 50% decline, right? Which would almost be what they did here. So in that situation, now it doesn't have to be a 50% decline. This one wasn't, right? But you could have a legitimate downturn that resets this market, which it's kind of trying to do, but there's so many people locked in with low interest rates, it kind of is screwy. So you just have to kind of sit back and say, okay, what do I think makes the most sense here? Do I think we're going to have this kind of shallow-ish 1991, 1999 type of reset in the housing down cycle, normal down cycle in housing, home building, and then this goes for the building products companies largely too, unless they have like a certain niche that's maybe data centers and something might be different now. But or is there enough risk of that 80% plus? I just used, in my mind, I think 80% drawdown happening. If I was able to go back to I think it was the 80s, yeah, when interest rates went up. So that was another big decline for, obviously, I mean, when interest rates are like 15% or something for your house, then you're not going to be able to afford very much of a house, right? So that was another 80%. It's not like the 2008-9 was the only big decline. That's a normal pattern. So when I look at it, I'm kind of cautious. I think we've had a gigantic run. This is like a super cycle almost. And or probably the risk is big enough where I would lean more toward the deeper decline than the shallower one. But I wouldn't push back too much against people if they waited for a 50% decline and then bought a little bit, especially if they had a bunch of cash. You know, when you get to like this kind of level, you're at like portfolio level decisions sometimes. Because if a person doesn't have any cash and they're all invested in stocks, then I would say wait for the big decline, right? You're not going to be missing out unless you pick very bad stocks. But if you have extra cash on the other hand, and the risk, your opportunity cost risk is higher if the market kind of comes back, then after 50% or 60% or whatever a person thinks, then you can, and you don't have to do it all. A person doesn't have to do it all at once. They can layer in a little bit, nibble a bit here, pick the very best home builders instead of the marginal ones. There's ways to up the quality, reduce the risk, still get some money in without making like a big, huge bet on it. And so that's how I would think about it. So I feel pretty balanced in my portfolio right now. I'm not saying I wouldn't buy one of these if it came down and looked like it made a bottom when it was down 60% or 70% or something. So I might not necessarily wait all the way to 80, but 50 even doesn't seem. Here's the thing. Imagine a stock peaks at $100 a share and it falls 50% to $50 a share and you buy it. And then it ends up bottoming at 75% off the high. Okay. So you might think that the difference between 50% drawdown and a 75% drawdown is a 25% drawdown in your mind. A lot of people think that. It's an easy mistake to make. And you think, oh, well, I can handle that. I can sit through that. But the difference between a 50% drawdown, which would be a $100 stock trading at $50, and a 75% drawdown is a $100 stock that peaked at $100 selling at $25. The difference between $50 and $25 is actually 50%, right? It's a lot. And mentally, I don't think folks, even if they know the drawdown history, realize that the distance between a 50% drawdown and a 75% drawdown is 50%. And then the difference between an 80%, I will hear this quoted sometimes, right? The difference between a stock that's down 80% versus a stock that's down 90%, right? Which you might think is a 10% difference, is actually also a 50%. That's like buying out stock that peaked at $100 at $20 and it falls to 10, right? That's also a 50% drawdown, not a 10% drawdown. So the deeper the stocks get off their highs, when you start thinking in this drawdown way, which is what I do for cyclicals, the magnitude of how far they can still fall is incredible. And that's why people freak out and sell. And that's when you get these good deals. Because not only will they freak out and sell, but it will look bad. Like the fundamentals will be horrible, right? Look at these guys back in 2008, extreme example. They are in 2007, which the home housing crisis or decline started in 2006, actually. And then it didn't affect the economy all the way until late 2007. And they didn't declare the recession until a year later after it already started. That's how smart these guys are. And this is why you can't wait for somebody else to tell you like the bad news is coming, all right? Or the bad news is here or whatever. So we have a huge loss. Let me see if I can see. Like this is probably, it only goes back to 2004. Man, time flies. It only goes back 20 years. But if you think $11 in losses, right, that was all the money they made during the bubble years, pretty much. Well, they had one more year maybe. So all that money that they made during the bubble was gone in 3 years. Like they've lost it. So it looked horrible. Everything was horrible. All the news was horrible. The fundamentals were horrible. Everything's bad. There's nothing good. And when you're down 90% and everything looks bad, or even before that, because people were selling all the way down, right? Eventually people reach that pain threshold. They give up and they sell, and nobody wants to buy is important too. Nobody wants to step in there and buy. So you kind of have to be resolute ahead of time, I think, or at least that's how I do it. So I know, okay, I know this can get down 80%. And when it does, it's going to look horrible. I'm going to buy some anyway. That's kind of, or 50% or whatever it happens to be. But it's worth thinking about it ahead of time, what you think you might be comfortable with. So you're not reacting to whatever the day-to-day, week-to-week, month-to-month news is. You have to take this big picture that even if you waited for a bottom back here, and you bought toward the end of 2009 when some of the disaster was over, you're still had almost a 10-bagger, right? So over the long term. And a lot of that came early. A lot of that you probably had by the 2018 little peak there. Okay, so hopefully that gives everybody something to think about. Home builders and generally speaking, materials, building stock, like you want something outside of housing and normal real estate development if you're for the material kind of building products companies too, I think. So if you have one that was small enough and niche enough and the area, like I said, data centers or something. I'm just picking that because everybody knows they're building them all over, and the stuff that goes into that, which they've already all run up. You're not going to go find a good deal in those. But I'm just pointing out that I'm making a lot of blanket statements. It could be some other little niche that has growth potential. If you can find it and identify it with a specific company, then, you know, okay, that's one thing. But broadly speaking, wait for those drawdowns. And, you know, I'm even leaning more toward waiting for some sign of recovery. You're going to give up a lot of gains off you're not going to be able to bottom pick much. I'll probably make a video on this before too long, either here or for Patreon, that I've been thinking about. I've kind of been doing it anyway, but people are asking me, why are you doing this? So I feel like I need to make a video of explaining it. All right, if you found this useful, hit the like and subscribe button, head over to Patreon, join the free tier, and I'll see everybody later.